Hello, fellow Rebel Capitalists. Hope you're well. So the Canadian housing market has been in a bubble for, a decade, maybe more. And the prices just continue to go up and up and up and up and up. And so we all know that it's a bubble. We all know that trees don't grow to the sky. So at some time, you're going to have a correction. Now, is that correction in a month? Is that correction in 2 years, 5 years? Who knows? And obviously, the government has come out and will continue to come out and try to prop up the market and do all these crazy things. Who knows? They may come out with a 100-year mortgage. But I didn't realize the extent to which the market is starting to crack right now as we speak. And why that matters is because what is happening in Canada, not just with the real estate market, but with the overall economy, is likely to happen in other major economies. And this is going to prompt the central banks to lower rates. And then the question is, can they compete with the United States? Can they compete with the Federal Reserve? And if they can't, then what happens to interest rate differentials? And what happens to currencies? And what happens to the dollar? And then what happens to all their dollar-denominated debt and the things that they need to buy in dollars? And this just goes around and around and around and around. So I'm going to go ahead and connect the dots for you here in just a moment. But before we do, let's go over to a recent podcast. Fantastic episode. And by the way, I love this podcast. It's the Market Huddle with my good buddy Kevin Muir and Patrick Ceresna. Patrick Ceresna, part of Rebel Capitalist Pro. Give him a shout out. But they are interviewing this gentleman who's an expert in the Canadian housing market. Now, let's go through a couple little clips here and listen to what they're saying. This is really fascinating. And this gentleman is Ben Rabidoux.
So this paints a pretty bleak picture for Canadian real estate, especially in the coming years. And one of the things
I should have gone over, I mean, this is a long interview, and you guys, it's well worth your time. But a quick Reader's Digest version is, we all know that the prices are astronomical. The the price to income ratios are just through the roof. But what they're doing now is it's at the point where like 30 or 40% of the mortgages in Canada are not just adjustable rate. Like they're all pretty much adjustable rate, but they're these really bizarre, I'd never even known this was a product, where they adjust. I think they might even adjust monthly or quarterly. The interest rate goes up, but it doesn't impact your monthly payment. What happens is they just add money to the principal, or you're just paying off less and less and less of the principal with each payment as interest rates do go up. See? So you can tell already that doesn't end well. Whenever you get to this level of financial engineering, you're like, okay, we need to pump the brakes here. This probably isn't a good thing. So just to be clear, if your payment, let's say, is $2,000 a month, but your interest rate, because you got in a low teaser or something like that, is 2%. But then the Bank of Canada hikes rates to 5%. So that makes all the other mortgage rates adjust from, let's say, 2 up to 7. I'm not giving you exact numbers, just using these for the sake of the example. Okay, well, your payment would go up massively. But instead, what happens is your payment stays the same. But if every single payment you were making, let's say $2,000, let's say $500 was going to principal and $1,500 was going to interest. Well, now all $2,000 is going to interest, and so you're not making any principal payments whatsoever because interest rates have gone up, and so they rejiggered the payment as far as what percentage goes to interest and what percentage goes to principal. So again, you were paying off $500 a month in principal. Now you're paying off $0. Now it's basically an interest-only payment. That's one thing. Another thing is, I guess all of these investors came in and started buying just speculative fever, along with everything else in the world right now. It's turned into a casino where they were selling pre-builds for condominiums. And this became such a bubble that the pre-build was actually selling, the builders could sell them for a higher price than the market. So let's just say that this condominium on the market would sell for $1 million. They were able to sell it for 1.3 million. And you don't even take delivery of it for 5 years, when you could go out and buy the same apartment or same condo for $1 million right now, the exact same one. But no one was, because it was all investors just gambling on the future price. And I mean, this is just the tip of the iceberg. I guess another thing that the government was doing was they were giving away these residence visas. And the only way you could get a resident visa is if you were a student. So what happened is all of these companies started setting up these universities. And really, it was just a mailing address. They like didn't even have a physical location. And they just have some sort of mailing address. And then they pitch all these Chinese on coming over and getting their permanent residency. All they have to do is pay them $50,000 for these classes that no one even takes. But because they're set up as a university, which is basically a mailbox, etc., then they can give the Chinese guy the diploma and he can go down and get permanent residency because he's a Canadian student, right? I mean, the level of shenanigans that have gone on in Canada that have pumped up their housing market is, I mean, it rivals GFC stuff. I mean, it might even exceed what happened in the United States during the run-up to the GFC. So again, you've got to listen, and I'm just scratching the tip of the or scratching the surface here. You got to listen to the whole interview, and they go over like line item by line item by line item the complete insanity of the Canadian real estate market. So that's what brings us up to the point where we are right now in the interview.
Things that you've been highlighting is that it'll be offset by a Bank of Canada that is forced to actually go and lower rates. And this is part of the reason that I was always kind of pushing back on my American friends that would say, you know, Canadian banks or Canadian real estate is a huge short, is that maybe the outlet valve will be the dollar.
And by the way, when he says the dollar, he's not talking about the US dollar, he's talking about the Canadian dollar. So what Ben's there, and that was Kevin obviously speaking, but what Ben's base case is because of what's happening in housing, because that's such a massive part of their economy, once the cookie starts to crumble here, the house of cards starts crashing down, the central bank will have no choice but to cut rates, and cut rates fast, because they've got to bail out all these people whose loan payments or mortgage payments are adjusting higher. And then he also goes over the knock-on effects of those really weird mortgages I was talking about earlier, where the payment stays the same. And that's even worse when he takes you through all the unintended consequences, let's say. So in his view, this is not George Gammon speaking, this is Ben Rabideau. He sees the stuff hitting the fan there in Canada in 2025, because so many of these mortgages and these crazy financial products are adjusting, or they'll have to effectively roll over the debt to a newer interest rate or a newer payment that most people won't be able to afford. So then the Bank of Canada comes in and says, holy cow, we wanted to slow down the market or the housing market, but not by this much. So they're going to have to bail everybody out by taking interest rates from, let's say they're at 4.5 right now, taking them down to 2 or 2.5. And then what Ben is looking at interest rate differentials, and then just coming to the conclusion that if they take rates down to 1.5, and let's just say the Fed's at 4 or 3%, that means the Canadian dollar will likely go down against the United States dollar. That's why he's saying that the release valve is going to be in the Canadian dollar. So what we have to understand as Americans is the US economy in dire straits. Yeah, or well, maybe a better way to say it is it's fundamentally unsound, and we're starting to see the cracks. As right now, we're starting to see the economic data soften. We're starting to see the unemployment rate go up, and all of the things that you guys have known about the economy, really since 2020, they're starting to come to fruition, and the artificial stimulus isn't able to kick that can down the road any longer. They papered over the problem. You guys know what the central planners did, the economic distortions that they created. But now those chickens are likely coming home to roost. Now, maybe they won't for another year, but at some point in time, they're going to have to pay the fiddler. And then will the Fed come back in? Will the fiscal start again? Probably. But you've got to go off the cliff just a little bit, at least, before they're likely coming in with something that's going to have any material impact. But my point there is that when you compare the United States, let's just look at the real estate market as a proxy for the whole economy. Is the U.S. real estate market wildly overvalued and in a bubble? Yes. Is it as bad as Canada? Not even close. Not even close. Is it as bad as Australia? Not even close. Now, I'm not saying to run in and buy U.S. real estate, but I'm saying, holy cow, you've got some other countries out there where things are really, really bad. So, likely, any reason that you would give for the Fed to cut rates, where I would agree with you, those reasons those variables are much worse in these other countries. Now, when you look at the debt to GDP ratio, what you have to do, and Ben points this out, is actually look at the consumer balance sheet. When you look at the private balance sheet in Canada, it's like 300% of GDP. I mean, it's bananas. So even if the Canadian government balance sheet is a little bit better than the United States, that likely won't be the case for too long, because when they drop rates, they're probably going to have to do stimulus, and they're going to have to take a lot of those debts from the private balance sheet and roll them over to the government balance sheet, which again likely puts downward pressure on the Canadian dollar because of the interest rate differentials with the Fed. Let's keep going here.
The Canadian dollar. And I just love to hear, I'd love to hear your thoughts about that. And then recently you've been talking about the fact that you think, although that will be an outlet valve, you're worried it could actually become such an outlet valve that it creates problems and they won't be able to release enough steam, in essence, because of the spread on the dollar.
Yeah, so you're right. That's always been my view, is this gets fended through the currency. Now, I wouldn't say that I think, look, again, my experience talking with folks in the lending industry, so mortgage brokers that are originating on behalf of the banks, I mean, I have a really strong view on things like the prevalence of mortgage document fraud in the Canadian lending ecosystem. It's way more prevalent than I think people realize. Look, I think there's more risk to bank balance sheets than people generally give them credit for. So it's not that I don't think there's some problems, kind of some bodies buried there, if you will. And I think some of that's starting to come to the surface. You saw TD get slapped for, anti-money laundering. Like, my view for a while has just been that.
So, I mean, every single thing that we did wrong in like 2004 to 2007, Canada has done it in spades. I mean, it's just really, it's jaw-dropping when you listen to this interview. Let's skip ahead a little bit here. I think they get into kind of the currency.
Strained in terms of how low they can cut, because the Federal Reserve needs to maintain a much more much tighter monetary policy to kind of stem inflation.
So again, it's not that the Fed is going to take a tight monetary policy, but tighter than Canada has the option to.
Stateside. That's kind of the nightmare scenario for Canada, because we get forced into higher rates, and even as the domestic economy weakens. And so that was always like a hypothetical that was out there, because the US and Canada are at different points in the monetary policy cycle. The vulnerabilities in the household lending ecosystem are so much greater in Canada. But now it seems like that's like a very real possibility.
Okay, so I skipped ahead there. What he's referring to is the Canadian Central Bank drops rates, and what happens is the Canadian dollar drops too much. Therefore, it creates even more economic problems in Canada. And then what happens is the Canadian Central Bank says we got to get closer to the Fed, wherever the Fed is at that time, because we've got to do something to strengthen the Canadian dollar, because it's creating all of these other problems. And I'm going to get into some of the problems that I'm referring to specifically here in a moment. So then they have to increase rates to get close to where the Fed is. And what happens is that just exacerbates the first problem, because then all those people in the housing market are still having to roll over that debt at that higher rate, which is crippling the economy even further. So they kind of paint themselves into a corner where you're damned if you do, damned if you don't. That's what Ben's talking about.
Yeah, like I've said, I think the Canadian dollar is going down to all-time lows. Do you feel the same
Yeah.
way?
I 100% agree. I think we're going to retest. Yeah, we'll get into the low 60s. I think. I don't. Again, who knows? But certainly that's what we're going to need. Now, what's interesting, Kevin? So you go back to the last time.
So Kevin is talking about the Canadian dollar going to all-time lows against the U.S. dollar. So here's where I want to switch gears a little bit and talk about why this is important for the global economy, why it's important for the U.S. economy, and why this is a much, 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 much bigger problem than just real estate. But real estate, it's like the GFC. The real problem was the monetary system, the collateral that was being used, and the fragility of the monetary system. If the monetary system would have been sound back during the GFC, it would have been a problem, but it wouldn't have been a global financial crisis. It would have been a U.S. and some other area real estate bubble that burst, and a lot of people would have gone out of business. But you wouldn't have had to bail out AIG and just all of these other crazy banks. I mean, you sit there and look at the mortgage default rate, and it only went from like 3% up to 5 or 6. That's a very common misconception, that we look back during those times and we think that the default rate on mortgages went from like 2% up to 20 or 30. Nah, it didn't. It really didn't go up that much, but it went up enough to where it mattered because of the fragility of the monetary system. And I think that the Canadian housing market could give us insights as to what we might expect, not just in Canada, but in other economies that could impact not just the banking system, i.e. the monetary system, but therefore the global economy, which obviously includes the United States. So let's go over to this. I don't know if you want to call it a paper. I'm a terrible writer. And this is basically a 12-page blog post that I did the other day on, I called it the dollar paradox. I basically went over kind of how the monetary system is structured and how that creates kind of this constant bid for dollars because the dollar denominated debt outside of the United States. So it's a lot of what Brent talks about, a lot of the dollar milkshake stuff, but it gets more so into the mechanics, where Brent really focuses on the U.S. relative to other countries, which is important. But I think it's also about the plumbing and how the system is structured, because this network is really, at the end of the day, what money is. It's just a network of commercial bank ledgers. That's what money is, because dollars, especially outside the United States, they're just simply a liability, a commercial bank deposit liability. So anyway, getting back to this paper, if you guys want to check it out, it's free. You just put in your email address. I don't even know the URL. The URL is georgegammon.com/the-dollar-crash-paradox. Josh, if you want to do me a favor and put that in the chat and then put that in the description of this video, I'd appreciate it. But what we're doing is we're skipping down to about the middle of the paper. And this is a scenario where dollars flood back into the United States. And I kind of go through this thought experiment. So what we're going to do, this isn't exactly what's happening in Canada, but the net effect would be the same, but the order would be slightly different. So here you look at this doom loop that I've got, and it shows the dollar going up first. But let's just flip the dollar going up and rates going up. So in the rates in the United States don't have to go up. They simply have to be higher than the rates in other countries. So if the Fed is keeping rates, let's say at 4%, let's say they drop down, but the Bank of Canada has to drop them all the way down to 1.5 or 1 or 50 basis points or something like that. That it has the exact same impact on the currencies as the Fed increasing rates. So we're really looking at the delta. When I'm looking at that arrow, basically I'm talking about the delta between the interest rates with the Fed and the ECB, the Bank of Japan, Australia, you name it. So what happens is the interest rate differential increases. So the rates in these other countries relative to the Federal Reserve, those rates go down, meaning the rates in the US are up, even if they stay the same. And what happens because of interest rate differentials, likely that puts upward pressure on the dollar relative to those other currencies. Now, I'm sure a lot of you right now are saying, oh, George, it doesn't even matter because the dollar is going down just at a slower rate. Okay, I get it, but that doesn't apply to what I'm saying right now. Right now, we're not talking about consumer prices. We're not talking about the cost of goods and services. We're only talking about the difference between these different currencies and why it matters. We're getting to that in just a moment. So the rates go up, or the difference in rates increases, and the dollar goes up. But see, what this does is it increases the debt burden. Because a lot of these countries, Canada included, although they have a lot of commodities, so they bring in a lot of dollars, that's good. But whether it's Canada, whether it's Australia, whether it's China, whether it's especially Japan, they need a lot of dollars because they don't produce those commodities they need. So they have to take on all this dollar-denominated debt, which is very short-term. Okay, well, if you have to borrow $100,000, and let's just say your interest rate is 1%, when you go to pay that loan back in 2 weeks, then let's say it's just 1% for the 2 weeks, you've got to pay back $101,000. So you've got to come up with $101,000 somewhere. But if the rates go up to, let's say, 10%, now all of a sudden you take out that $100,000 loan, and when you pay it off in 2 weeks, you've got to come up with $110,000. You've got to come up with an additional $9,000. So that's where we come to this debt burden increases. You guys can see where I've highlighted it. And A, because higher rates means more dollars are owed. So the demand for those dollars increases because at the beginning you only need 101,000. Now you need 110,000. So since you need more dollars, that means dollar demand increases. But let's remember that the value of the dollar relative to the local currency is higher, and therefore, to get those $110,000, you got to sell even more of your local currency. So if you got to sell even more of your local currency, then that increases the global supply of the currency. And then what happens to the FX rate? It gets worse if you're holding Canadian dollars, right? So then the Canadian dollar continues to go down, and the dollar relative to those other currencies continues to go up and up and up. But each time it goes up, it increases the debt burden even further to the point where they just start to default. And then it starts impacting the banks, which impacts the global monetary system, which impacts the global economy, which then would impact the United States. So then I go into something that not too many people talk about, but if this happens, if the Fed has interest rates that are, let's say, appropriate for the United States, not that they get it right, let's assume that they do for a moment, but these interest rates are way too high for all of these other economies to handle because what's happening with the dollar, then you could see a scenario where those balance sheets are starting to become impaired, like we talked about earlier, because of the defaults. But then what we have to realize is money, quote unquote, dollars, are just simply a liability of that bank. So if they go bust, what happens to their balance sheet? What happens to their ledger? It's gone. So then what happens to all the money? Well, that's gone too. And then you get into this wicked deflationary cycle. Now, what happens to consumer prices? I don't know. That's a completely separate topic. But when I'm talking about deflation, I'm talking about credit, debt, assets that depend on that credit and debt. And at a certain point, obviously, that spills over into the global economy, very similar to what we saw in the GFC. Now, don't get me wrong. I'm not saying that the Canadian real estate market having problems or showing cracks is going to create a GFC type scenario. That's not what I'm saying. But I'm saying if you take this to its logical conclusion, and if what Kevin and Ben are saying is true, then you've got to assume that this could play out. And if it plays out in Canada, then it's likely to play out in other countries. And when I'm talking about it playing out, I'm talking about the dollar going up relative to these currencies, increasing the burden of the debt, and then getting that deflationary cycle with asset prices and deflationary cycle when it comes to the extension of credit and debt. And I'm just now noticing that I didn't switch up the screen share, so you guys couldn't see what I was talking about there. That's frustrating. I forgot. Let me just show you real quick here, guys. I was explaining this whole entire process, and I had all the visuals, and you guys couldn't see it. So here are the visuals that I was trying to that I thought I was showing you earlier. Here is this doom loop that I was referring to. Here's where we kind of started in the middle of the blog post, and here's where I went down to showing the balance sheets with the entities and the banks, and how the entities' asset, dollar asset, cash assets are the same as the bank's liabilities. So the bank goes away, then those assets that the entity have, those go away as well. And again, if you guys want to check out the whole entire paper, if you want to call it that, you can just go to georgegamba.com, the-dollar-crash-paradox, and you can just put in your email list, and you can download this whole thing, which is pretty extensive, for free. If there are any typos in there, forgive me. Like I said, I'm not a writer, I'm not an editor, but hopefully it will make sense. And Josh, like I said, please do put that in the description and in the chat. And on that note, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.